Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
JP Morgan lowered its 2026 year-end S&P 500 target to 7,200 from 7,500, ultimately warning that investors have become too complacent in their expectation that oil price spikes will be short-lived. The U.S. stock market has been resilient amid surging oil prices since the Iran war began nearly 3 weeks ago. JP Morgan said this relative calm relies on one high-risk assumption by investors, which has led to a sense of complacency about the war. JP Morgan said, quote, "We believe the market is pricing in a quick end to the Middle East conflict and that the reopening of the strait given a low probability to a potential demand hit. This is a high-risk assumption, given that the S&P 500 and oil correlations typically turn increasingly more negative after a 30% oil spike. Oil prices have now risen more than 46% since the U.S. and Israeli initial strike on Iran, yet the S&P 500 is down less than 4%. Analysts said investors have been hedging rather than de-risking, explaining that high-risk and speculative areas of the market, such as software, South Korean equities, and crypto, have sold off, removing some froth, but complacency persists. This is important because year-end price targets, they're moving targets, but when the numbers are coming down, it can change the psychology of expectations, what people are willing to pay. Oil prices have risen 46% since the U.S. and Israelis' initial strikes. Much of the market's attention has been focused on the inflationary impact from higher oil prices. They think that the bigger and more consequential question is the potential negative transmission mechanism into demand if the strait does not reopen. This week, the war escalated in terms of targets, with both Israel and Iran targeting part of the energy complex of natural gas. Iran is going after neighboring countries, and that's new too. Much of the market's attention is focused on the inflationary impact of higher oil prices, but the transmission mechanism is what Wall Street's worried about today. Bank of America has raised a similar concern, warning that investors' focus on the inflationary impact of the war is overshadowing the more significant risk of a synchronized global slowdown driven by a more prolonged war. Fortunately or unfortunately, depending on how you look at it, the U.S. is protected from some of these issues on natural gas and oil because we have our own. That can't be said for China and most of Europe. Citadel Securities made a similar call this week, noting that it sees risk shifting from inflation to growth. JP Morgan warned that the subsequent oil supply deficit will hurt global GDP and slow revenue growth and will also raise the risk of recession. They pointed out that 4 of 5 oil shocks since the 1970s led to a recession. Not surprisingly, since supply shocks often translate into demand destruction, the oil shock from the war in Iran comes at an already challenging time for the market. There's a lot going on. There's software-specific concerns, software as a service apocalypse, with Claude showing us that we may not need basic engineers to do coding in the future. There's private credit worries. There's uptick in retail redemptions. People are checking out of the markets. AI trade is losing steam. There's an affordability crisis in homes. There's a cooling labor market. And the Federal Reserve's tough balancing act to manage the economy going forward. This week, the Federal Reserve said we might do one rate cut this year. That's not what Wall Street wanted to hear when we had these hefty price targets at the start of the year. Let's talk about what I just talked about. Housing. From pandemic boom to mid-decade stall, housing delivered extraordinary gains at the start of the 2020s, but the middle of the decade has told a different story. Nationwide home prices surged more than 50% in just the first half of the decade, one of the fastest appreciations on record. That kind of move was never sustainable. Prices pulled forward years of future gains into a short window, leaving little room for continued upside without a major decline in mortgage rates or another shock to demand. Even if rates were to fall meaningfully, the reality is that home prices are already so elevated relative to where they were just a few years ago that affordability remains strained. The gains have already been locked in by existing homeowners. New buyers are facing a much higher hurdle. 30 years ago, when I got into this industry, I heard a lot of people say a home was the best investment I ever made. I go, it's not really an investment. It's a liability because you have to pay it. Or the bank comes and takes it away if you don't pay it long enough in your mortgage payments. But it does work as an asset over time. I don't doubt that. One interesting development is that the median price to income ratio has come down from its 2022 peak. That sounds like progress, but it hasn't happened because housing became cheaper. Instead, it's largely the result of wage growth catching up while home prices stalled. Historically, housing doesn't crash often. The more typical outcome after a major boom is exactly what we're seeing now. Flat prices while incomes slowly catch up. That dynamic reduces affordability pressures without the economic damage that usually accompanies a housing bust. So rather than a dramatic collapse, the mid-2020s have looked like a real return recession in housing. Prices moving sideways while inflation and wages erode the real value of the homes. The stagnation shows up clearly in sales activity right now. Over the past year, roughly 4.1 million existing homes were sold in the United States. That might not sound terrible until you compare it to the long-term average of 5.2 million, and the historical average occurred when the U.S. population was much smaller. Since the start of the century, the population has grown from 280 million to 343 million, yet housing turnover has fallen. In other words, there's more people than ever in the United States, but fewer homes changing hands. That's a sign that the market isn't collapsing, but it also isn't functioning efficiently. Homeowners are locked into low mortgage rates, buyers are priced out, and the result is a housing market stuck in place. The low transaction volume is only one part of the problem. The U.S. is also not building enough homes, which prevents prices from falling, but also prevents the markets from resetting in a healthy way. A shortage of new construction supports home values, but it also means fewer opportunities for first-time home buyers, limited mobility for existing homeowners, and weaker long-term returns because high prices suppress demand. Demographics were supposed to be a major bullish force for the housing this decade. Americans in their prime home buying years represent the largest demographic cohort in the country. Following the great financial crisis, there was a persistent narrative that younger generations would abandon home ownership entirely. That never really made a lot of sense. The reality is people still want to own homes, but the environment is radically different from the 2010s. Homes are more expensive, mortgage rates are far higher, and the inventory remains tight. So even though demand exists, it's been constrained by affordability rather than lack of interest, limiting price growth and transaction activity. None of this means housing has been a disaster, even though it's been a very weak asset class in the mid-2020s. Prices haven't collapsed. Homeowners who bought before or during the pandemic are still sitting on significant gains. An investment in the middle of the decade, though, has been underwhelming. Prices are largely flat. Transaction volumes depressed. Affordability still stretched. Real returns eroded by inflation. Predicting future asset class returns is notoriously difficult. Very few people coming out of the great financial crisis expected the U.S. stocks to compound at 14 to 15% annually for the next 2 decades, or for gold to become one of the strongest performers in the early 2020s. Housing could still surprise to the upside, but based on the current setup, it's reasonable to assume that easy gains in housing are behind us, at least for now. I have a Pints and Portfolio coming up. It's a good chance for me to buy you a beer and us talk about where you sit in your retirement planning issues. Sign up for it at robblackshow.com. Sunnyvale, California, April 18th, Saturday from 11:30 to 1:30.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
We're experiencing a down market, and I think the question on the minds of many is how much further lower can we go, and when should I buy or should I sell now? Bank of America's Michael Hartnett is leaning on one of the more reliable breadth-based capitulation signals on Wall Street. It's worth understanding or trying to understand why investors, professional investors, take it seriously. The 88% rule, what does it actually mean? Hartnett tracks the percentage of global equity indices trading below both their 50-day and 200-day moving averages. When too many markets are above those averages, he thinks the market is overbought, which is a contrarian sell signal. When a large majority fall below, he thinks panic and forced selling are widespread, which is a contrarian buy signal. His research suggests 88% below those trend lines historically will get you strong forward returns. We're not there yet. Markets need another 3 to 5% drawdowns to trigger it. This is a breadth capitulation signal, not a valuation one. And I don't know what type of investor you are. I know that I'm a little bit more complicated at times than I want to be. Indices can look stable while the average stock is collapsing. That's exactly what's happening right now. The S&P 500 recently slipped below its 200-day moving average for the first time in nearly a year. Beneath the surface, over 80% of stocks in some sectors are already in downtrends. So the signal is telling us we're late in this correction cycle, but not yet in the panic phase. So Hartnett uses 88%, not 70%, not 95%. This threshold comes from backtesting across decades of global data. Historically, markets tend to bottom when selling becomes indiscriminate, not when news gets bad. At 88%, the selling is no longer selective. Everything is being dumped, including quality assets. That's the classic capitulation behavior where you get margin calls. You get quants, hedge funds, deleveraging. You get the risk parity starting to unwind and flows out of ETFs. Those are the moments that produce V-shaped rebounds. How close are we today? The S&P 500 is 5 to 6% off its highs. The Dow and the NASDAQ are approaching correction territory. The Russell 2000 is already near. We're in the late innings of a correction, not at the bottom though. That's consistently being told to us. Breadth signals outperform sentiment surveys because they capture global positioning, ETF flows, systemic selling, and liquidity stress. This is tactical, not structural. I'm not saying that the economy is weak or strong. What he's trying to say is positioning will be washed out. Historically, after this signal, you often get a 6 to 12 month rally, but not necessarily the start of a new secular bull market. The bigger strategic takeaway now from a portfolio construction perspective is the 3 phases. Denial, which indices near highs. The breadth starts to deteriorate. We're already past that. The second phase is correction, a 5 to 10% decline. Leadership starts to crack. We're currently in that phase. And then we need to hit capitulation, which is indiscriminate selling, which signals buy signals ultimately. We're not there yet. We're not at the capitulation. People aren't panicking. Again, this is not my opinion. This is Bank of America's Michael Hartnett, and why he's looking for capitulation signs to be it's time to buy. Elsewhere, Supermicro stock dove today after U.S. charges employees with smuggling NVIDIA chips to China. That stock's down 25% off its market value. This Supermicro story is really bad news for Supermicro. They're not a stock I own or would want to own. I'd prefer to own Dell. Dell's the winner today. Pinterest CEO is calling for a ban on social media for children under 16. I like this as a parent. Other countries do it, and it just feels like the United States is behind on this. Pinterest CEO Bill Reedy called on world leaders to ban social media for youth under 16 in a LinkedIn post on Friday. We need a clear standard, no social media for teens under 16, backed by real enforcement and accountability for mobile phones, operating systems, and the apps that run on them. Mark Cuban says he thinks the humanoid robot push will fail in 5 to 10 years. I like Mark Cuban. He's not someone I invest with. I just like hearing him talk. He's always interesting to me. He believes in a future where humans live alongside robots, just not the ones with the walking around kind of robots that media tends to focus on. His quote at South by Southwest was, "Everybody's making this push for humanoid robots. I think they might have a 5-year lifespan, and then they'll fail miserably." Humanoid robots have plenty of fans like Elon Musk, who said he believes Tesla's Optimus could be the company's future. OpenAI has quietly built up a humanoid robotics lab. Mark Cuban said he thinks co-designing spaces and robots would be better than simply making robots that mimic humans and fit into the world as it currently exists. I agree. I've got some steps in my house, and the idea of robot going up and down it, and maybe you can program it for human speed, or maybe you can program it for the children's speed. It just seems annoying to think about. Can't say my dog would like it either. Mark even thinks that robots that look like spiders or ants capable of lifting and carrying things, while the house could be designed so that the pantry, refrigerator, and washing machines are hidden, with the robots primarily interacting with them, while the actual living space is used for people. Jeff Bezos this week is seeking $100 billion for an AI-enhanced manufacturing fund. One thing you got to say about Amazon is their logistics are unbelievable. Jeff Bezos started Amazon back in the 1990s, created one of the greatest investments of all time. The fund that he's building a portfolio of cash for, it's going to be used to fund Project Prometheus, where Bezos was recently named co-CEO. The startup aims to apply the latest generative AI breakthroughs to reinvent industrial manufacturing. There was a great article in the Wall Street Journal that talked about being a college student and how Generation Z sports betting is wrecking people's lives. It's probably the number one thing that I'm most feared about for the future of my kids is online gambling. He said as a freshman, he would see other freshmen placing $200 wagers on an NBA game. As an 18-year-old using your own debit card to regularly place bets, he's not out of the norm. It's a common thing now, and it's starting to ruin a lot of our college kids' lives. Sites like FanDuel, PrizePicks, BetMGM, they make it all too easy to pick up the habit. The legal gambling age is 18 in a handful of states. The American Gaming Association, which represents the major betting platforms, requires that 73% of the audience for ad campaigns be 21 or older, and it prohibits marketing on college campuses. I remember being young in college, and I couldn't believe that credit cards would set up booths and put pretty women in them and give away free T-shirts. And just seeing the line of college kids sign up for something that's going to financially hurt them. Come find me at a Pints and Portfolio, Sunnyvale, California, April 18th, 11:30 to 1:30. It's a Saturday. Learn more about it at robblackshow.com.
Questions about Social Security? Check out the Social Security Retirement Guide at robblack.com. That's robblack.com, powered by EP Wealth.
There's been a lot of talk recently in the analyst community about Apple's big AI advantage. It's simple, that they have 2.5 billion devices. That could power the next decade of stock gains. In the world of technology, we tend to focus on what's new, whether it be new products, new features, new buzzwords. Sometimes the most important story is not about what a company is building next. It's about what it's already built. In Apple's case, that number has reached a historic milestone. More than 2.5 billion active devices currently in use around the world. Now that includes iPhones, iPads, Macs, Apple Watches, and AirPods. All connected, all receiving updates, and all part of one of the largest and most valuable consumer technology networks ever assembled. This isn't just a vanity metric. It may be Apple's most powerful strategic asset as artificial intelligence becomes the next battleground in tech. There's going to be the enterprise battle, and there's going to be the consumer battle. I think it's safe to say that Apple is close to a lot of consumers, 2.5 billion to be exact. Now, Apple doesn't measure its success primarily by units shipped in a given quarter. Instead, it emphasizes active installed base, devices that are still in use, still connected, and still interacting with Apple's ecosystem. Pretty crucial distinction. A company that sells a device that once generates a single revenue event, a company that maintains an active device creates recurring opportunities for services, for upgrades, accessories, and now for artificial intelligence features. With more than 2.5 billion active devices, Apple effectively operates a persistent global platform that it controls end to end. The Apple platform is larger than most countries. To understand the scale of 2.5 billion devices, it helps to compare it with population numbers. That installed base is equivalent to roughly 1/3 of the global population and significantly larger than the user bases of most individual software platforms. But Apple's network is different from social media platforms or from web services. Apple users are not anonymous accounts. They are owners of premium hardware, often with credit cards on file, and years of purchase history. That makes Apple's installed base not just massive, but very economically powerful. The hidden value of high-end users is that Apple's ecosystem is unique in that its customers tend to spend more than average on technology, services, and apps. This is why developers prioritize building for Apple platforms, even when Android has more total users. An iPhone user is statistically more likely to subscribe to services, make in-app purchases, and upgrade hardware regularly. This creates a feedback loop where the best apps appear first on Apple, which is reinforcing the platform's attractiveness. Artificial intelligence is rapidly becoming the defining feature of consumer technology. But AI is not just about building models, it's about distributing them. Companies like Google and Microsoft distribute AI through the cloud. Their models run in data centers and are assessed through web browsers or APIs. Apple has taken a different approach, running AI on the device itself. This strategy depends entirely on scale. Training AI models is expensive, but deploying them efficiently requires billions of endpoints capable of running them locally. Apple already has those endpoints in consumers' hands. Apple has long marketed privacy as a core differentiator. Running AI models directly on devices allows the company to keep personal data local rather than sending it to the cloud. This approach has two advantages. Lower latency. AI responses are faster because they don't require a network round trip. And stronger privacy. Sensitive data remains on the device. These benefits are not theoretical. They align with the growing regulatory pressure in Europe and increasing consumer awareness around data security. Apple's pivot to its own chips was a big moment. Starting with the M1 and continuing through the latest A-series processors, it's transformed its ability to run advanced AI workloads locally. By designing its own silicon, Apple has been able to integrate specialized neural processing units optimized for machine learning tasks. This is similar to how NVIDIA builds GPUs tailored for AI training, but Apple's chips are designed for mass deployment, not just data centers. This distinction matters because Apple is not trying to train the world's biggest models. It's trying to run billions of smaller, personalized models efficiently. Think of Apple's installed base as a giant distributed computing network, one where the hardware is owned and powered by consumers rather than the company itself. If Apple releases a new AI feature in iOS, it can theoretically reach hundreds of millions of users within weeks. No other hardware company has this level of direct software-controlled reach. This makes Apple less dependent on massive cloud infrastructure than many of its competitors, which could protect margins over time as AI costs rise. One of the biggest concerns for Apple investors over the past decade has been slowing hardware upgrade cycles. Smartphones have matured, and many users keep their devices for longer periods of time. AI could change that dynamic. If new software features rely on the latest chips for full performance, consumers may once again feel compelled to upgrade to access the best capabilities, just as they did when mobile cameras or high-resolution screens first became mainstream. This would shift the narrative again, from hardware saturation to AI-driven hardware refresh. Apple's services segment, which includes iCloud, Apple Music, Apple TV, and the App Store, has become one of the company's fastest growing and highest margin businesses. This segment exists entirely because of the installed base. Every additional active device represents another potential subscriber. As AI becomes embedded in operating systems, Apple may find new ways to monetize intelligence itself through premium AI features, developer tools, or enterprise offerings. Apple's not just a technology leader, it's one of the most powerful cash-generating companies in history. The company produces tens of billions of dollars in free cash flow annually, which allows it to invest heavily in research and development, acquire smaller companies, repurchase shares, and pay a steadily growing dividend. This flexibility in finances gives Apple the ability to make long-term bets on technologies like AI without jeopardizing short-term profitability. Now, some people don't like buybacks. Some people don't like dividends. Dividends are a tax event for some. But over the past decade, Apple has executed one of the largest stock buyback programs ever. By reducing its share count dramatically, the company has amplified earnings per share growth even during periods of modest revenue expansion. This capital allocation strategy has been a major factor in Apple's long-term stock performance. As long as free cash flow remains strong, continued repurchases can provide a floor under the stock. Now let's talk about the dividend. Apple's dividend yield remains modest compared to with traditional income stocks, but its consistency and growth rate matter more than its size. Regular dividend increases signal confidence in future cash flows. They attract a broader base of institutional investors, including income-focused funds that may not have previously held large positions in tech stocks. Hardware specifications are easy to copy. Ecosystems are not. That's Apple's competitive moat. It's the ecosystem. It's not the hardware. Switching away from Apple often means losing access to purchased apps, breaking compatibility with other Apple devices, and learning new interfaces. This creates switching costs that are psychological, financial, and practical all at once. As AI features become more deeply integrated across devices, phone, laptop, watch, and even car, those switching costs could increase further. No investment thesis is complete without considering risks. Here's the big risks on Apple. It's regulation, it's China, and its pace of innovation. Apple faces regulatory scrutiny over its App Store policies in the United States and Europe. It also relies heavily on manufacturing in China, exposing its geopolitical tensions and supply chain disruptions. Another risk is perception. Apple has sometimes been viewed as late to a major technological shift, including cloud computing and generative AI. If Apple fails to deliver compelling AI features, despite its installed base, the market could question whether the company's ecosystem's advantage still matters. Looking out just a few years, by the end of the decade, that's crazy to say out loud, Apple may no longer be seen primarily as a smartphone company. Instead, it could be viewed as the operator of a global personal computing network, delivering services, software, and intelligence across billions of devices. This is similar to how investors eventually stopped viewing Apple as just a hardware company and began valuing it as a platform and services provider. Investors tend to focus on quarterly iPhone sales because those numbers are easy to measure and compare. The installed base, by contrast, grows slowly and rarely produces headline-grabbing changes. But in the era of artificial intelligence, distribution may matter more than raw innovation. The company that can deploy AI to the most users the fastest may end up capturing the greatest long-term value. Apple's 2.5 billion devices give it an unmatched distribution advantage. Technology history is filled with examples of companies that invented important technologies but failed to capture the majority of the economic value because they lacked distribution. Apple has the opposite problem. It already has the distribution, billions of devices in pockets, bags, and homes around the world. If the company can layer compelling artificial intelligence on top of that network, it doesn't need to win the AI race by building the biggest models. It just needs to deliver the most useful intelligence to the largest number of users. And in the long run, that may be the kind of advantage that moves not just product cycles, but stock prices as well. Of note, Amazon said this week that they plan a smartphone comeback more than a decade after the Fire Phone flop. I've got a Pints and Portfolios coming up. It's all about making sure you do the age 20 to 60 well enough so that you can live great from 60 to 100. Saturday, April 18th, 11:30 to 1:30, Sunnyvale, California. Sign up at robblackshow.com. That's robblackshow.com.
Visit The Rob Black Show online at robblackshow.com. Listen to archived podcasts, market updates, and information from EP Wealth's certified financial planners online at robblackshow.com.
Thanks for listening today. One of the things that I love most is interacting with you. Even if sometimes it's a little annoying to be asked, what should I buy? I say buy great companies. What price should I pay? I say buy great companies. Over time, that's going to work. Now, if you're 60 plus years old, that's not a great idea. Here's a company I've talked about recently that one analyst says this might be the time to buy. Mizuho is raising its price target by a few bucks on Chipotle Mexican Grill. He sees positive catalyst, citing strong channel checks, traffic, and comparison upsides. Stock is really, really not showing anything positive right now. So that's a pretty cute, intelligent, it's an inflection as a call. It's an inflection call. McCormick is in talks to buy London-listed Unilever's food business, valued at about $33 billion. McCormick is a U.S. spice maker. What's interesting about McCormick is in the 1950s, Americans had 4 spices in their spice cabinet, and salt and pepper were 2 of them. Probably oregano. Today, if you go into someone's spice cabinet, I have 50 spices at least. I love getting spices as a gift or giving them as a gift. Netflix is $2.8 billion richer after losing Warner to Paramount. They got a big breakup fee. Let's talk a little bit about Netflix. Now, first and foremost, yesterday I noticed that Paramount stock hit its lowest level since 2009. Are you kidding me? That's horrific. Netflix. Stock has been on a tear ever since the streamer dropped out of the bidding war for Warner Brothers Discovery. Shares are up 17% in the past month. Paramount Skydance beat Netflix in the fight for Warner. That's done nothing but hurt the CBS owners' beaten down stock. Paramount has cratered 16% over the last month, while Netflix is up 17%. Paramount's paying a stiff price, and in its winning bid may turn out to be a horrible victory. I think Netflix is still interesting. I could see it getting to 115 this year. There's scope for Netflix to raise its full-year earnings. There's potential streaming price hikes, which I think we're going to see every 2 years. Essentially for the rest of our life, it feels like. There's a potential for a buyback because Netflix just got $2.8 billion for not buying. They got a breakup fee. Buybacks would give the stock an instant boost. There's speculation on that, so it's not known yet, but that's what Wall Street's looking at. It was a good thing that Netflix lost the bidding war there. NVIDIA is giving Apple vibes. I saw that headline somewhere. The artificial intelligence boom is entering a new phase. For the past 2 years, the story was simple. Companies were racing to train giant AI models, and that meant buying as many GPUs as possible. And in that first phase of the AI revolution, one company dominated, NVIDIA. But revolutions evolve, and the next stage of AI is not about training, it's about running those models. That stage is called inference. It's where long-term economics of artificial intelligence will be decided. At NVIDIA's most recent GTC conference this week, CEO Jensen Huang made one thing very clear, that NVIDIA is not just a chip company. It's trying to become the entire operating system of artificial intelligence. When you step back and look at what NVIDIA is building, it starts to feel very familiar. It looks a lot like Apple, which we talked about today. For years, investors misunderstood Apple. They thought Apple was simply a hardware maker selling iPhones and Macs. But over time, it became obvious that Apple wasn't selling devices. It was selling an ecosystem. The hardware, the operating system, the developer tools, the services, the app store, everything worked together because Apple controlled the entire stack. NVIDIA is trying to attempt the same strategy of the walled garden. Instead of designing one chip and letting customers assemble their own systems, NVIDIA is designing GPUs, CPUs, a networking switch, system software, AI frameworks, developer tools, and even reference data center architectures. This level of control will give NVIDIA something every tech platform craves, which is optimization across layers. When chips, networking, and software are designed together, performance per watt and performance per dollar both improve. And that's what makes NVIDIA systems not just powerful, but economically compelling. That economic argument is crucial because AI is incredibly expensive to run. The cheapest platform often wins. CUDA is NVIDIA's hidden moat, if you will, the secret weapon, software. Back in 2006, NVIDIA released CUDA, which stands for Compute Unified Device Architecture. It allowed developers to use GPUs for general purpose computing rather than just graphics. Over time, researchers, engineers, startups built entire code bases around CUDA. Today, millions of developers rely on it. This is very similar to Apple's iOS ecosystem, where developers write apps in Apple's environment, and that keeps users tied to Apple devices. CUDA does the same thing in AI. Once a company builds its models and pipelines on NVIDIA software, switching becomes painful and expensive. From training to inference, this is the next wave. Training a model is expensive, but it happens occasionally. Inference running the model happens every time someone asks a chatbot a question or an AI agent executes a task. That shift changes the economics of AI hardware. Companies are now optimizing for lower latency, lower power consumption, and lower cost per query. NVIDIA's newest chips and software stacks are built around exactly that problem. The company is designing systems where training clusters and inference clusters work together seamlessly. If NVIDIA succeeds, it won't just sell chips. It will sell AI infrastructure as a platform. Free cash flow at NVIDIA is exploding. What will they do with that cash? Reinvest? Acquire? Buy back stock? Or pay dividends? NVIDIA is doing all those things now. Not much in dividends. But they've said from their 40% free cash flow going back to the shareholders, they're going to up that to 50%. I do have an event coming up. It's Pints and Portfolio. I'd love to see you at the event. We can talk about stocks I own, stocks you own. We can talk about how's retirement looking, how's financial planning for retirement going, what mistakes are you making. It's robblackshow.com. It's in Sunnyvale, California, Saturday, April 18th, 11:30 to 1:30. Thanks for listening.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.